Welcome to the next session, and just a quick recap of what we've done so far. We've spoken in session 1 about some fairly basic charting patterns and charting techniques that have been used for decades, centuries in fact, by many people. In session 2 we developed that a bit further, and I think actually took it to a new level. Because one of the fundamental mistakes that the chartists of old used was believing that the key to these patterns was actually being able to predict the next direction. What we now know is that you don't even need that, and in fact you are far better off without it. So I think we've taken a very sound basis, we've refined it a bit, and on top of that we've added a couple of indicators that are now available to us by virtue of having computers that can make spotting them and identifying the best ones a little bit easier. So that's basically, we've dealt with the setups. There are many chart patterns, but we've selected the 6 that are most likely to lead to the explosive moves that we are looking for. And that's the whole focus of this course, is about finding the moves that are ones that once they trigger, they move quickly, and ideally don't give you too much grief in the process. So those are the 6 chart patterns and the way we use them that basically completes the setup. But we don't yet have a trading program. We don't have anything like a trading program. We've just got the setup. And in order to move this on to the next stage, we need to talk about what we do once we have a setup in place. So we need to talk, first of all, about what is our entry trigger. Secondly, we need to talk about what is the risk point, because we've got to use a stop. We've always got to use a stop. Wherever you enter the market, you've got to have a risk point where you say, it's not working, I'm getting out, I'm cutting my loss quickly. So those are the first 2 things we need, are the entry and the risk point. Then after that, we'll go on to trade management and exits, etc. Now the good news is this: because we have taken away the need to worry about direction, and we are simply going to go where the market tells us it's going to go, whether that's consistent with the chart pattern's predictive powers, supposed predictive powers or not, we're going to go where the market tells us it's going to go. Because of that, the entry and risk point associated with each of these 6 very different patterns, with what we're going to do in this program we're building, is the same. We can treat all of the 6 in exactly the same way. So you're looking for 6 particular types of trade setup. But then when it comes to actually having one in front of you on the screen, the trade entry you use and the risk point you use are basically going to be the same thing for any of those patterns. So although we're taking this on to the next level by starting to add the next pieces of the jigsaw puzzle into it, it's not going to grow exponentially of the things that you've got to think about. It's not a case of we're going to enter different patterns in different ways. So we're going to treat them all the same. Let's now talk about the biggest problem that I've ever seen with people trying to trade off chart patterns. And what we're going to do, we're just going to pick one. We're going to use our triangle here for no other reason than, as we've said before, the triangle is the most common of the patterns that we see, and therefore we'll just use this as the example. Do not, please do not do what everybody I've ever seen and everybody I've ever read about tells you to do. Do not do this. Do not do this. Do not place a buy stop above the outer boundary of your triangle to get in. Do not place a sell stop below the lower boundary of your triangle to pull you in if the market goes down. Do not place a buy stop above the last swing high, or the last swing low, or the one before it. Do not do these things. I'll tell you why. Go back to those charts and look at the number of times that you saw a nice pattern formed, and along the way there was a spike that went up and came back down. Remember, we said they don't have to be clean. You can cut 1 or 2 spikes off and still have a nice compact pattern. If you place buy stops or sell stops anywhere in these areas where people traditionally tell you to trade chart patterns with, you will get skinned alive. I absolutely guarantee it, and I don't want you to go through the experience of learning the hard way that I did. You don't use buy stops or sell stops to enter these patterns at all. So, having said what we're not going to do, let's talk about what we are going to do. The most important price of the day is the closing price. The second most important price of the day is the opening price. Why is that? Most people look at bar charts and think the high and the low are the most important, the most significant points, because they mark the extent to which the market's managed to trade that day. They are not the most important prices that occur during that price bar. The reason the open and the close are the two most important prices of the day are because that's where the majority of the volume gets transacted. The highest volume of the day takes place around the open and around the close. And therefore, those are the significant points that we want to be thinking about when we are mapping out a trading plan like this, especially if it involves some sort of breakout strategy, which is really what this is. So, what we are going to do is forget the buy stop, sell stop nonsense. We are going to wait for this pattern to do something, to trigger an entry. And the triggering of an entry is not going down there and immediately coming back up and closing back inside the pattern, because that is all that's doing is taking out the sell stops of the people that are trying to do this the old way, and it's putting them into a position, and it's basically stopping them into a position they don't want, and then it's going to punish them. And that's us just drawing our triangle, saying, oh, there's a spike there, we'll just carve that off because we don't need that. Well, that was somebody getting into the trade the wrong way. So what we're going to do is we're going to wait until we get a bar that comes out of the pattern and closes, importantly, that's the important word, it closes outside, clearly outside the boundary of the pattern, whether that's a triangle, a line, or an ascending wedge, whatever it is, it's got to close clearly outside that boundary. If it's right on the boundary, not good enough. It's got to be clearly outside the boundary. And then what we're going to do is we are going to enter the trade at that closing price. If you're if you're watching the live market, then literally in the last 5 minutes you can see where it's going to close, you get in at the close. If you're intending to trade this as an end of day trader, you're literally going to just pull up your charts for 10 minutes of an evening after doing whatever you want to be doing during the day, that's fine, because all you do then is you just buy the open the next day. There may be a slight difference between where the market closes and where it opens. Occasionally you'll find there's a little bit of a gap there, but in the scheme of what we're trying to achieve here, that's fairly minimal. The important thing is getting that close outside the pattern, because that's the high volume time of the day, the highest volume time of day, and the market is confirming it is now ready to start leaving this old home and going in search of a new one. And that's what we're looking for. If you focus on the close, that will save all end of brief. So that's what we're going to do with each of our 6 patterns. It's as simple as that. We just want a solid close outside the pattern. Outside the pattern. Now, the other thing is this. If you end up with a bar that comes out and substantially closes lower than the high, then the other thing you can do, if you're not really quite sure, if you're thinking, well, that closes outside the pattern, but it's a long way off where it actually got to, then you can place a buy stop above the high. That's the time you can enter on a stop if you want a little bit of added confirmation. Okay, so you will find occasions, and when we look at the charts, you'll see this. There will be times where you think it's gone up, it has technically triggered, it's closed above the boundary of the pattern, it's not as convincing as it could be. Then just use the buy stop above the signal bar and then let the buy stop pull you in when it resumes the following day. So that's not that's not obligatory, but it is an option if you are at all concerned that you've got a valid close. So that's basically the entry. It's that simple. The focus is getting the patterns right and making sure you get that close, and then that's it. It's as simple as that. We just enter on that close. Then next thing we need is going to be a risk point. Where do we put our stop? Where do we decide this trade isn't working, please get me out, and I want to get out with just a small loss, because I know if I don't take a loss, when I've got the opportunity to take a small loss, it may well go the other direction and cost me a lot of money, and that's what we're trying to avoid. So we now need a risk point. Now the thing about the signal bar, the signal bar is the bar that confirms the breakout of the pattern and closes and gives us our entry. So when I talk about the signal bar, this is the bar I'm talking about. The thing about the signal bar is that it will often be a large bar. It will typically be twice the size of the bars that preceded it, of that sort of order. Now, if it's not, if it's just the same size as these preceding bars, then we will use 2 bars for our stop, not 1. So if we've got a large bar, then we will literally use the bottom of that bar to put our stop behind. Okay, not right at the bottom, a little bit further back, a few points further back, but basically we're going to use the signal bar. That's our risk. But we do require the signal bar to be a substantial bar, typically twice the size of the bars that preceded it. As I say, just to recap, if it's a small bar, if it's the same size as these bars, then we would say I'm going to use the last 2 bars and count that whole thing as my signal bar, and I will place my stop below the low of the second bar back. Okay, this is just a driving by eye way of saying you need a 2 ATR stop as a minimum stop for this strategy. ATR is average true range. For those who understand more about technical analysis and average true range, I know we've used it previously in the indicators we were using in session 2. We didn't delve into it in a great deal of depth, but basically you need a minimum of 2 ATRs to hide your risk point behind, because any closer and you could just get a bit of noise will just take you out. So it's a minimum of 2 ATRs. Some people nowadays in fact say you should have 3 ATRs as your risk point. Somewhere in the middle of those extremes is probably the right number to use. But the reason we only need 2 is this. Remember, we're looking for an explosive move out of here. We have probably got, we hope we have got anyway, a number of contracted range bars that precede our signal bar. Our signal bar in the ideal world will be the first bar that's gone from the cycle of small bars to big bars, small bars to big bars. So if we are right and our signal bar is a big bar, then hopefully that is the first of a run of big bars. Make sense? So that's why ideally the signal bar is big, and that's usually sufficient to hold our stop, to hide our stop just behind that. We don't need to give it a lot more room than that, because the thing is got to explode. That's what we're after. And if it doesn't explode, if it just fizzles its way out of the pattern, it may still work. But we don't want to be betting a lot of money on the fact that it's going to work when it's suspect if it doesn't explode out of here. So we're prepared to give it the benefit of the doubt, but only to the tune of like 2 ATRs of risk. So doing it by eye, if it's a big bar, just below the low of the signal bar. If it's an average size bar, below the low of 2 bars back. And this doesn't happen very often, but if for any reason the second bar back let's say that was the second bar back, where we had the low of the second bar back wasn't actually very far from the low of the actual signal bar, and the signal bar was still just a normal size, then the worst case is use the center of the pattern as your risk point. Okay, so you've got three choices there: big bar, bottom of the bar; normal size bar, bottom of 2 bars back. Ultimately, don't let it go. You don't want to see that price go back beyond the middle of the bar if you haven't got the opportunity to use the 2 bars or the 1 or 2 bars to hide the stop behind. Now, if only use that as a fallback. Don't say I am going to take the smallest of these 3 options. Okay, that's just a fallback if you haven't actually got an obvious place to put your stop, right? Because it may be that your signal bar is quite a big bar down here. That's good. That's not a bad thing. Don't worry about the fact that we are using a big bar as our risk point and start thinking, well, I'm risking more money than I want to. That's a separate conversation. What we're talking about is finding a risk point that's going to give us the highest probability of success with this strategy. If you're risking too much money in dollar terms, that means you're either trading too many contracts, too many shares, or the wrong type of markets. And that's a conversation we'll have in a minute. We'll find a way of getting the actual dollar risk involved to an amount that you're comfortable with in a minute. So for now, what we want to do is focus on maximizing our chances of being successful with this trade. So if that big bar happens to be below the midline of the pattern, don't worry, you still use the low of the bar if you can, okay, for your risk point. Okay, so I hope that's clear. You only use the midline of the pattern if you literally do not have anything else to go by. Use the price bars if you can.